Welcome to another chapter of our USA History series. In this episode, we uncover the dramatic events that unfolded during the 2008 financial crisis, a defining moment that tested the resilience of the American economy. The year 2008 marked a watershed moment in American history, as the nation faced one of the most severe economic downturns since the Great Depression. This period, known as the 2008 financial crisis, had far-reaching consequences, reshaping the economic landscape and prompting unprecedented government intervention to prevent a complete collapse. In this essay, we will explore the causes, the domino effect, and the measures taken for recovery during this pivotal chapter in U.S. history. Causes of the 2008 financial crisis. At the heart of the 2008 financial crisis were multiple interconnected factors that collectively created a perfect storm. One key element was the proliferation of subprime mortgages. Financial institutions, driven by a fervor for profit, had been offering mortgages to individuals with poor credit histories, creating a housing bubble that was destined to burst. As housing prices plummeted, homeowners found themselves underwater, owing more on their mortgages than their homes were worth. The collapse of Lehman Brothers in September 2008 served as a catalyst, sending shockwaves throughout the global financial system. Lehman's bankruptcy exposed the fragility of major financial institutions and eroded confidence in the entire banking sector. The interconnectedness of these institutions exacerbated the crisis, leading to a credit freeze and a loss of trust in financial markets. The domino effect. The fallout from the collapse of Lehman Brothers rippled across the economy, triggering a domino effect with dire consequences. Financial institutions faced insolvency, requiring massive government bailouts to prevent a complete collapse. Unemployment soared as businesses, especially those in the financial and automotive sectors, struggled to stay afloat. Families faced the grim reality of foreclosure as the housing market crumbled. The global nature of the crisis meant that economies worldwide were interlinked in their struggles. Trade diminished, and governments grappled with the challenge of stabilizing their own economies while facing the repercussions of a weakened international economic system. Government intervention and recovery. In response to the economic freefall, governments around the world, particularly the United States, implemented unprecedented measures to stabilize and revitalize their economies. The Troubled Asset Relief Program, TARP, was a linchpin of the U.S. government strategy. Enacted in October 2008, TARP authorized the Treasury to purchase troubled assets and inject capital directly into struggling financial institutions. Simultaneously, the Federal Reserve aggressively lowered interest rates to stimulate economic activity, and the government rolled out stimulus packages to boost consumer spending and support struggling industries. These interventions aimed not only to prevent a complete financial collapse but also to jumpstart economic growth. The recovery process was arduous, marked by fluctuating unemployment rates, slow GDP growth, and ongoing challenges in the housing market. However, the combination of government intervention, fiscal stimulus, and regulatory reforms contributed to a gradual stabilization of the economy. Lessons learned and lasting impact. The 2008 financial crisis left an indelible mark on the American psyche, prompting a re-evaluation of economic policies and financial regulations. It highlighted the need for robust regulatory mechanisms to prevent excessive risk-taking by financial institutions and underscored the importance of transparency in the financial sector. Legislative responses, such as the Dodd-Frank Wall Street Reform and Consumer Protection Act, aimed to address the systemic issues that contributed to the crisis. Dodd-Frank introduced measures to enhance financial stability, regulate derivatives, and establish the Consumer Financial Protection Bureau. Moreover, the crisis sparked a broader conversation about income inequality and the social consequences of economic downturns. The Occupy Wall Street movement, which emerged in the aftermath of the crisis, drew attention to the perceived injustices in the financial system and the growing wealth gap. Conclusion. The 2008 financial crisis was a watershed moment that tested the resilience of the American economy and prompted significant shifts in economic policies. While the recovery was gradual and uneven, the crisis underscored the need for a balance between free market principles and regulatory oversight. As we reflect on this period in U.S. history, the lessons learned from the 2008 financial crisis continue to shape economic discourse, policy decisions, and the collective memory of a nation that weathered an economic storm and emerged changed but resolute. As we conclude this chapter, we witness the remarkable resilience of the American economy. Join us in the next part as we explore the repercussions of the crisis, the lasting impact on financial regulations, and the lessons learned from this transformative period in U.S. history.